Hello. This is the 30-second episode of What Would Peter Lynch Do, which explores the wisdom of legendary investor Peter Lynch. We got a really great question from one of our listeners. They asked, when making direct investments, I have to create a portfolio, but I'm having trouble. What stocks should I choose, and how many should I make up?
Hmm.
So this deep dive is basically our compass for anyone feeling, a bit overwhelmed by building their first stock portfolio. We'll unpack Peter Lynch's timeless wisdom and blend it with practical strategies for today's market.
That's a fantastic question, really. It gets right to the heart of individual investing, doesn't it? Building your own portfolio, yeah, it can feel like a maze at first. But with Peter Lynch's ideas as our guide, it definitely becomes much clearer. We're going to try and turn that daunting task into more of a strategic adventure.
Okay, let's unpack this then. Peter Lynch always stressed, the importance of understanding your own situation before you even glance at a stock ticker. He'd probably tell you to, look in the mirror and ask three core questions. These are like your personal investment compass. First, what are your investment goals? Why exactly are you putting money in the market? Is it for retirement way down the road, maybe 20 years, or a down payment on a house in, say, 5 years, saving for kids' education? Knowing your why is it's the absolute bedrock.
Exactly. And right alongside that, why is your investment horizon? How long do you genuinely plan to keep this money invested? Are we talking short term, like 1 to 3 years? Because then capital preservation is really key. Or is it long term, 10 years plus? That opens up totally different possibilities. Your timeline, it's a huge factor in the kinds of assets you should be looking at.
And crucially, your risk tolerance. How much, ups and downs can you actually handle without freaking out? Are you more conservative, prioritizing stability? Or are you okay with more aggressive growth strategies, the kind that come with bigger swings? This isn't just about what you can afford to lose financially. It's also about the emotional roller coaster you're willing to ride.
That's the key, yeah. Think about it, someone saving for retirement that's still a decade away.
Yeah.
Their portfolio is going to look completely different from someone saving for, I don't know, a wedding in 3 years. Their goals, their timeline, their comfort with risk, it's all distinct. These three questions, they really dictate everything that comes next when you're building that portfolio.
Right. So once you've got those foundational questions answered, we get the golden rule of investing. Don't put all your eggs in one basket. It's an old saying, sure, but it's totally central to Peter Lynch's philosophy, too, even though, he's sometimes pushed back on how far people took it.
That's right. Diversification is kind of like your portfolio's safety belt. It's designed to protect your overall money by minimizing the hit if one specific investment or industry takes a nosedive. So it means spreading your money across different sectors, tech, healthcare, finance, consumer goods, instead of piling too much into just one. And while we're focusing on stocks today, true diversification could also mean including things like bonds or real estate. But for this deep dive, yeah, we'll stick mostly to stocks, to equities.
Okay, so for individual investors, how do we actually do this? How do we put on this safety belt in a way that makes sense? Our sourced material points to a really popular method, pretty easy to grasp, the core satellite strategy.
Yeah, it's an excellent framework. So the core portfolio usually makes up, say, 50% to 70% of your total investment. Think of this as your stable anchor. It's designed to basically track overall market growth. For this core part, you look at broad market ETFs, exchange-traded funds. They're basically baskets of stocks that follow an index. So you might look at S&P 500 ETFs, things like SPY, IVV, or VOO, or maybe a NASDAQ 100 ETF like QQQ, or even a Dow Jones one like DIA. You could also put blue chip stocks in here, those large, well-established companies, long history of stable performance like Apple, Microsoft, Johnson & Johnson, maybe Visa.
Okay, so that's the solid foundation. Then we've got the satellite portfolio, which is the other 30% to 50%. And this is where you can kind of inject your personality and aim for potentially higher returns, right?
Exactly. The satellite part is where you invest in areas you're really interested in or places you think have major growth potential. This could mean growth stocks in cutting-edge fields, AI, robotics, biotech, companies maybe like NVIDIA, Tesla, Amazon. Or maybe you're hunting for value stocks, companies whose share prices seem kind of low compared to what the business is actually worth. Think Berkshire Hathaway or JP Morgan Chase. Dividend stocks are another option, ones that pay out regular income like Procter & Gamble or AT&T. And thematic ETFs, those focusing on specific trends like cloud computing or semiconductors, they can be great satellite additions too.
That actually perfectly answers the first part of our listener's question. How should I distribute my portfolio across industries or stocks? Basically, use that core satellite idea and make sure your satellite part is still reasonably spread out across different ideas or themes.
Absolutely. So like a more conservative investor, their 70% core might just be broad market ETFs. Simple. Then their 30% satellite could lean towards stable stuff, healthcare, blue chips, consumer staples, maybe high dividend stocks. But an aggressive investor, maybe they have a 50% core NASDAQ 100, S&P 500 ETFs, and their 50% satellite is heavily into, say, AI stocks, maybe some biotech ventures or specific emerging market plays. A smart approach, though, whatever your style, is probably to mix things up. Blend growth industries like IT and healthcare with more stable ones like finance, consumer staples, utilities. That mix helps your portfolio handle different market weather.
That makes a lot of sense. Okay, now the second part of the question, what is the appropriate number of stocks to hold? This is such a classic question for new investors.
It really is. And look, there's no single magic number, but we can definitely point out the traps. Holding too few stocks, like just 1 to 3, that's putting yourself at huge risk. If one of those companies hits a major problem, your whole investment could be in serious trouble. But flip side, holding too many, say, 30 or more, makes it almost impossible to really analyze and keep track of each company properly. You're basically running your own mini fund at that point, often with more hassle and maybe not even better results.
So where's the sweet spot then for someone managing their own money?
Generally, Peter Lynch himself suggested that an individual investor can probably effectively manage and really know about 8 to 12 companies. That range gives you enough diversification to spread the risk, but it's not so many that it becomes overwhelming. You can actually understand the businesses you own. And a quick tip, especially for U.S. stocks. If picking individual companies just feels like too much right now, you could actually build a really effective satellite portfolio with just, say, 3 to 5 diverse ETFs, mixed market ones, sector ones, maybe a dividend one.
Building it is one thing, but yeah, it's definitely not a set it and forget it deal. What about actually doing it and then managing it once it's set up?
Right, that's where discipline really kicks in. First, think about dollar cost averaging. Instead of throwing all your money in at once, buy in chunks over time. It helps smooth out the bumps from price swings by averaging your purchase cost. Second, you've got to monitor it regularly. Peter Lynch was big on paying attention to your companies. Review your holdings, maybe quarterly or semi-annually. Could line it up with earnings seasons for U.S. stocks. Check how they're performing, what the outlook is, and importantly, how the weight of each stock in your portfolio might have drifted.
And if those weights get way out of whack, what do you do then?
That leads straight to rebalancing. So if a stock has just shot up and now it's like way too big a piece of your pie, you'd sell some, lock in some profit and bring it back to your target size. On the other hand, if another stock has lagged and its weight is now too small, you might buy more to bring it back up. This disciplined process, it naturally makes you sell high, buy low over time, helps keep things stable.
That's really practical stuff. The source material also hits on some, bigger picture wisdom that Peter Lynch was always talking about, like emotional trading is forbidden. Absolutely cannot let the day-to-day market noise or scary headlines push you off your plan.
Absolutely. And Peter Lynch believed you have to study constantly. The market changes, industries shift. You've got to build your knowledge, keep reading economic news, company reports. It's ongoing homework. And one last piece of advice, can't stress this enough, something Lynch really lived by: start small. Seriously. Instead of jumping in with a huge amount, it's way smarter to gain experience, build your own investing philosophy with money you can afford to, learn with. That trial and error builds real confidence and resilience.
Okay, now here's a really sharp question from our listener. It gets right to the heart of it and kind of pushes back on some of that textbook advice. Doesn't this much diversification lower returns? If diversification is so important, I can just buy a fund or ETF and forget about it. The point of an individual spending time and effort to build a portfolio is to increase returns. Your advice is too textbook.
Wow, that is a fantastic, really sharp question. I totally get where they're coming from. It's absolutely true. If your only goal is textbook diversification, just spreading things out super wide, it's going to be very hard to get returns that significantly beat the market average. The whole reason an individual puts in the time and effort, right, is precisely to go beyond just playing defense. It's about trying to get returns that beat the market through your own perspective and analysis. So if our earlier advice was maybe more focused on not losing assets, this question forces us to look at it from a more aggressive angle, focusing on actively growing wealth.
So how do we chase those higher returns then, without just gambling?
Well, counterintuitively maybe. To boost returns, you often have to reduce diversification to some extent. Warren Buffett, Peter Lynch's contemporary, famously said something like, diversification is a hedge for ignorance. So how do you do smart, concentrated investing? first, maybe redefine diversification a bit. In an aggressive strategy, that broad market ETF isn't really your core anymore. It's more like your benchmark or a minimum safety net.
Yeah.
Your main goal becomes making sure the stocks you pick outperform that ETF. The ETF is just kind of insurance against the possibility that I might not beat the market.
That's a really interesting way to frame it. So it's about being selective and really backing your picks.
Exactly. Your returns ultimately come down to which stocks you pick, not just how many. Textbook diversification can kind of water down the impact of good stock picking, those excess returns. They usually come from a select few choices, from spotting value or growth that others missed. Peter Lynch always talked about sticking to your circle of competence. If you're a doctor, you get healthcare. Software developer, you understand IT. You don't have to force yourself to invest in, I don't know, mining companies just to tick a diversification box if you know nothing about them. Often, the path to better returns starts not by spreading thin everywhere, but by concentrating on maybe 1 to 3 industries you really feel confident about. And then within those, bet on a few great companies. Instead of owning 10 or 20 merely good companies, maybe concentrating your money in just 3 to 8 truly great companies, ones you're convinced will dominate for the next decade, that can lead to much higher returns. But yeah, it takes serious work to find those gems.
Can you give us an example? Like, what might that kind of concentrated portfolio actually look like?
Sure. So this example, it drastically cuts down the number of individual stocks, maybe to around 5 to 10 total holdings. You might put, say, 40% in a safety net, maybe a broad S&P 500 ETF like VOO. That's your baseline, your insurance. Then another 40% goes into core conviction plays. Maybe just 2 or 3 stocks here. These are the ones you've researched inside and out, strong moats, the companies you genuinely believe will lead the market for years. Think like a Microsoft or maybe ASML in the semiconductor space. And the last 20% could be in high growth potential plays another 2 or 3 stocks. These are often smaller, maybe more volatile companies, but with potential for like 5x or 10x returns if they hit it big. Maybe a cutting edge AI firm like Palantir, or a speculative biotech venture.
Okay, that definitely sounds like it could lead to some big wins, but wow, the risk seems much higher too.
Yeah. It is, absolutely. It's a classic high-risk, high-return scenario. If your concentrated picks really work out, you could see returns that just blow away what you'd get from a simple ETF. But if 1 or 2 of your big bets go wrong, the impact on your whole portfolio is much, much larger. It could be quite painful. This strategy, it demands really deep study, understanding the businesses, and frankly, a strong stomach to handle the inevitable drops without panicking. So, to answer the listener's question directly, doesn't diversification lower returns? The answer is basically yes, it tends to. So if you're really aiming for those higher returns, you likely need to reduce diversification and concentrate on a few companies you believe are truly great. Finding your personal balance, between defending what you have through smart diversification and chasing excess returns through focused selection and concentration, that's the eternal homework for every individual investor.
That's a very clear explanation. But it brings us right back to another sharp point from our listener. But you told me not to put all my money into 3 stocks. Isn't it better to go with 8 to 10? They're right, it sounds a bit contradictory.
You're absolutely right to flag that potential contradiction. It's a really important distinction to make. When I warned earlier about putting everything into just, say, 3 stocks, I was mainly talking about blind investing, basically gambling by dangerously concentrating your money without deep analysis or understanding. That's very different. The 3 to 8 stock concentrated portfolio I just described, that's intended as an expert-level aggressive strategy, specifically based on deep research and strong conviction aimed at beating the market. But Peter Lynch himself, even while running a huge fund, always advised caution for individuals. Most of us, let's be honest, are not Peter Lynch or Warren Buffett. We generally want to avoid a situation where 1 or 2 bad bets could wipe out a huge chunk of our savings. We need to survive mistakes.
So pulling all this together, where's that practical sweet spot for most individual investors? The ones who want growth, but need to manage risks sensibly.
Right where your listener pointed. The most realistic, I think, and intelligent balance point. The one that avoids watering down returns with too much diversification, but also dodges the fatal risk of extreme concentration, is probably a portfolio of about 8 to 10 stocks. Maybe up to 12. Why that number? Well, it allows for meaningful concentration. You can still put a decent chunk, maybe 10% each, into companies you truly believe in. Let your best ideas actually drive returns. But it also offers manageable risk. Look, if one of your 10 stocks goes completely bust, unlikely, but possible you lose about 10% of your total investment, compare that to losing 33% if one of only 3 stocks fails. That 10% hit is much more survivable. Plus, it's realistically manageable. Trying to deeply follow 20 or 30 companies, that's a full-time job for most people. But keeping up with around 10, that's achievable.
Okay, that makes perfect sense. So if you picture investment strategies on a kind of spectrum from, I guess, safest to most aggressive.
Yeah, you could see it like this. 1 to 3 stocks. If done blindly, that's extreme risk, almost gambling. If done by a true expert with deep conviction, it's a god-tier strategy, but very rare. 3 to 8 stocks. That's aggressive concentration. Higher risk aiming for high returns. Requires skill and nerve. But 8 to 12 stocks, that's what we'd call realistic concentration. It's probably the ideal balance point for most serious individual investors. You get the benefits of picking your own stocks, but still have reasonable diversification. Then, 20-plus stocks. You're basically running your own personal fund. It'll likely be stable, track the market maybe, but generating significant excess returns becomes very difficult. So yeah, for most individual investors who want to capture returns and also avoid complete ruin, building a portfolio with maybe 8 to 10 companies they really know well and believe in, that seems like the wisest and most powerful strategy.
Got it. Okay, I understand the ideal number. But now the next big challenge. How do I actually pick them? And maybe even harder, how do I hold on to them? Especially with news flying around constantly, or when a stock I really believe in takes a hit on some bad news. Like, is there any advice for selecting them, sticking with them? And related to that, how long should I even hold a stock?
Oh, I completely get that. Maintaining your conviction, staying calm when a stock you've researched drops. It's honestly one of the biggest psychological hurdles for every single investor. The problem of how to believe and hold on is, in many ways, just as tough as which stock should I buy? And the only real shield against emotional decisions and all that market noise is having a clear set of investment principles that you develop for yourself.
Okay, so how do we build that conviction and then maintain it?
Peter Lynch's mantra was key here. Buy the business, not the news. If you buy stocks just based on headlines or tips, yeah, you'll lose faith fast when things get bumpy. You have to invest by really understanding the company, the business itself. Ask yourself the tough questions before you buy. How does this company actually make money? What's its edge, its economic moat? What makes it hard for competitors? Is its industry likely to grow over the next 5-10 years? Is the management team good, trustworthy? And importantly, is the stock price right now cheap or expensive compared to the real value of this business? If you can answer those confidently, then when the stock price drops because of some temporary bad news, it might actually look like a golden opportunity to buy a company I like on the cheap, rather than a reason to panic.
That's a much healthier mindset. Anything else to help kind of lock in that conviction and stay disciplined?
Yes, definitely. Write your own one-page investment thesis. Seriously, once you decide to buy, just briefly jot down why you bought it, what you expect to happen, and under what specific conditions you would sell it. Like your reason for buying might be buying company A because the EV market should grow 20% a year for 5 years, and A's battery tech is 2 years ahead. Your conditions for selling might be sell if competitor B launches better tech first, or sell if EV market growth stalls completely. If you have this written down, when you feel anxious about a price drop, pull it out. If your selling conditions haven't actually happened, then logically, there's no reason to sell in a panic. It becomes a kind of safety device against your own emotions.
That's smart. Okay, what about the holding period? How long do you hold? Is there a rule of thumb?
No set period, really. Peter Lynch famously said, basically, hold it as long as your reason for buying it remains valid. He also used that great analogy, water the flowers and pull the weeds. So many investors do the exact opposite, right? They sell their winners quickly to lock in small gains, pulling the flowers, and they hold on to their losers forever, hoping they'll come back watering the weeds.
So when should you sell strategically? When do you pull those weeds?
Well, you should consider selling when you genuinely find a clearly better investment opportunity. Meaning, you're convinced a different company offers much better prospects or value than the one you currently hold. Opportunity cost, right? Or, and this is the most critical reason, sell when your original investment thesis is fundamentally broken. The company's edge disappears, its industry starts dying, management messes up badly. Also, maybe consider selling if a stock gets wildly, excessively overvalued, caught up in some kind of market mania. Trees don't grow to the sky. But these are generally bad reasons to sell. Just because the price went up a lot, if the story's intact. Just because the price fell, again, if the story's intact. Or just because the stock feels boring now. Successful investing, it's usually a long-term journey. Walking alongside a business as it grows, holding on with conviction based on your analysis, not getting shaken out by market noise as long as your core reasons remain valid.
Okay, let's get practical again with fund allocation. Listener asks, when allocating funds for a portfolio, how do I distribute among 12 stocks? All with the same amount? or do I vary the weight for each stock?
That's another really sharp practical question. Okay, you've picked your, say, 12 stocks, how much money goes into each. This step is super important. It really shapes your overall returns. To give you the short answer first, just putting the same amount in each an equal weight strategy is the simplest way. But it's probably not always the best way. A more sophisticated approach, and often the ideal one, is to vary the weights based on how strong your conviction is for each stock and maybe how much risk you see in it.
Okay, so what are these different allocation strategies? Can you break them down?
Sure. First, you have the equal weight strategy. Dead simple. Divide your money equally. 12 stocks. Each gets 8.3%. Pros. It's easy, and it automatically manages risk a bit, prevents you from going too heavy on one thing. Cons. It dilutes your returns. Your absolute best idea gets the same weight as your maybe 10th best idea. So even if your top pick doubles, its impact on the total portfolio is limited.
Right, so what's considered the most ideal way, especially if you've done the research and have strong opinions?
That's likely the conviction-based strategy. Here, you allocate more money to the stocks you have the highest conviction in, based on your deep analysis. You can even think in tiers, like Tier 1, core conviction plays. Maybe 2 or 3 stocks. You put, say, 15% in each, so that's 45% of your total portfolio right there. These are your best ideas, the ones you expect to really drive returns. Strong moats, deeply researched. Then, Tier 2, quality growth stocks, maybe 4 or 5 stocks, each getting around 10%. That's another 40–50%. These are solid, stable growers, kind of the reliable backbone of the portfolio. And Tier 3, exploratory or satellite stocks, maybe 3 or 4 stocks, getting only 5% each, so 15–20% total. These could be higher potential, higher volatility plays. Your jokers or home run hitters you're taking a smaller bet on. Pros here. Maximizes potential returns from your best ideas, and it systematically manages risk by putting less into the riskier bets. Cons. It's harder. Requires really deep understanding and honest self-assessment. If you're wrong about your top conviction picks, it can hurt more.
Okay, makes sense. And what if someone's absolute top priority is just not losing money? Defense first.
Then they might lean towards a risk-based strategy. Here, you basically allocate money inversely to how volatile a stock is. Stable, big blue chips that don't swing wildly get a higher weight. More volatile, high-growth stocks get a lower weight. Pro. It definitely enhances portfolio stability, especially when the market drops. Cushions the downside. Con. It can hold you back in a strong bull market. Your returns might be lower because you've limited your exposure to the very stocks that might be soaring.
So thinking about our listener, maybe newer to direct investing, what's the best starting point or recommendation?
For beginners, I'd generally say start with the equal weight strategy. It's simple, helps you get your feet wet, build confidence without taking oversized risks on any one name. As you gain experience and you start feeling really confident in your analysis of certain companies, then moving towards the conviction-based strategy makes a lot of sense. That really aligns with why you're picking individual stocks in the first place, to overweight your best ideas. If not losing money is truly paramount for you, maybe blend in some elements of the risk-based approach, practically. Maybe use conviction-based as your main guide, but be flexible. Make small risk adjustments within those tiers. Like if one of your top Tier 1 stocks is way more volatile than the other, maybe trim its weight slightly from 15% down to 12% just to acknowledge that extra risk.
This has been incredibly helpful, really practical. Okay, final crucial question. What did Peter Lynch himself actually say about all this? The number of stocks, how to allocate capital. How would he have tackled these questions we've been discussing?
Right, the big question. What would Peter Lynch do? If he were listening, I think this is what he might emphasize. On the number of stocks. Now remember, Peter Lynch ran the Magellan Fund, which held like 1,400 stocks at its peak. But his advice for individual investors was completely different. His core message was, owning stocks is like having children. Don't get involved with more than you can handle. He suggested that a typical part-time individual investor probably only has the bandwidth to really analyze and follow maybe 8 to 12 companies well, which lines up perfectly with our discussion about that realistic, concentrated investing sweet spot. But here's the classic Peter Lynch twist. He also insisted you don't need to own more than 5 stocks at any one time if you simply can't find 5 truly compelling opportunities. He strongly warned against buying mediocre companies just to fill up slots in your portfolio. He famously said something like, if you can't find anything you like, put the money in the bank. Don't force it. So his conclusion wasn't about a specific number. It was, focus on a small number of good companies that you can understand and manage in depth, based on your own ability and time. If you deeply understand 3 great companies, own 3. If you can handle 8, own 8. Quality over quantity.
That's pure Peter Lynch. Practical, focused on understanding. What about capital allocation? Do you just say go with conviction?
Or did he have a system?
Oh, he had a system. It was much more structured than just subjective conviction. Peter Lynch famously categorized stocks into 6 basic types or stories, and he allocated capital and set expectations based on which category a stock fell into. It's a really sophisticated way to think about building a balanced portfolio. 1. Slow growers. Big mature companies, growing just a bit faster than the economy. Think utilities, maybe some established food brands. They provide stability, maybe dividends. Lynch gave these a small defensive weight. 2. Stalwarts. Large, reliable companies still growing consistently, maybe 10-12% a year, like Coca-Cola or Procter & Gamble. Good and defensive plays offer stable returns. They might form a solid 10-20% foundation, offering protection in downturns. 3. Fast growers. This was Peter Lynch's bread and butter, the engine for returns. Companies growing 20-25% a year, often small, agile, with potential to be 10-baggers, go up 10x. Think early Microsoft or Home Depot. He'd put a significant chunk here, maybe 30-40%, but spread across several fast growers to manage the inherent risk. 4. Cyclicals. Companies whose fortunes rise and fall with the economy, autos, airlines, steel, chemicals. Timing is absolutely everything here. Lynch's allocation would be flexible, buying low in the cycle, selling high. 5. Asset plays. Companies whose stock price didn't reflect the true value of assets they owned, maybe hidden real estate, patents, or even cash. These were hidden gems requiring deep digging. Allocation based on conviction in the hidden value. 6. Turnarounds. Companies recovering from big trouble, bankruptcy maybe. Potential for explosive returns if they succeed, but high failure rate. Lynch would only invest a small speculative amount here, knowing the odds. So you see, Peter Lynch's allocation was like building a team. He methodically mixed his fast growers, the engine, stalwarts, the defense, and when the time was right, maybe cyclicals or turnarounds, the special teams or jokers. He gave a real blueprint for figuring out each stock's role and how much weight it should carry based on its fundamental story.
Today's Lynch quote reminds us that this principle is connected not only to investment decisions, but also to life wisdom. Maybe think about how Peter Lynch's approach, really understanding a business's story before investing, could apply to your own big decisions in life. Choosing a career, buying a house, what story does it have? What's its economic moat, its unique advantage, and what are its genuine growth prospects? Something to chew on. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.